Facebook will report first quarter results after the close today, and there's a number of exciting things that are going on with this company right now, so it's definitely going to be an interesting call. And since there are so many things, we thought it would be interesting for us to live stream our earnings model updates as the company reports. So if you check back on our YouTube channel at 4 p.m., we'll actually update our earnings model for the current quarter as soon as the company issues the press release. And we'll just kind of like talk through the changes. And keep in mind that management doesn't actually give their guidance until the conference call. So we won't have that detail in there right away, but we'll just work with what we have and work through the income statement and the balance sheet, the segment details, and the cash flow statement. And then we'll just be able to take a look at the valuation change in after hours and see if it makes sense in real time. So if you're interested in Facebook, definitely join us for that. There are a number of really interesting new things that are going on with Facebook right now. We had to change our model to include the virtual reality business. So we have a section, and we'll walk you through that now. This section that goes through the Oculus Rift revenue and gross margin. And then we also have a placeholder for the Samsung Gear VR because we know that it's shipping with the Oculus software. So there'll be some revenue contribution there. We're not really sure what it's going to be. So for the time being, it's just going to be a placeholder in our model. And then for this quarter, we'll be watching for signs of continued revenue growth without significant ad load. So that's kind of the key. We don't want to see anything impact the user experience. And they've been pretty successful at doing that so far. A lot of the advancements come with the more relevant advertising. So they're getting actually more revenue for less ads, which is key. So you want to see that continue to happen. And they also have a number of platforms that still have yet to be monetized. So Instagram has been monetized, but it's early in the ramp. They have WhatsApp and Messenger, which could be huge next year. So those are some other things that we're keeping an eye on. So with that, we can get started. So if you want to download the guidance, it's available on the investor relations page. If you click on earnings and you go to last quarter's results, you can see there's the press release, all these details, and then the transcript. So we've actually already saved the transcript and we've highlighted the guidance points here. And if you want to download our earnings model, it's available on our website, gutenbergresearch.com. And these are all free. Just scroll down to the Facebook model and you can see we put a little comments in here the last time it was updated. So this was updated prior to the first quarter results. So we're good to go. Just click the icon and it downloads right here. And then we'll scroll over to this model. So just quickly, in the upper left-hand corner of our model is our summary of our valuation metrics. Anywhere you see these columns in dark gray headings, those represent the historic actual results. And then the light gray headings, represent future forecasted periods. Orange cells represent consensus estimates, so you can see we've calibrated our top-line revenue and bottom-line EPS estimates to meet the street's estimates. Below the income statement, we have segment details, and you'll see that some of these cells are shaded in blue. These represent our primary assumptions. So the assumptions down here in the segment details are what's driving the income statement up above. So if you want to download this model and plug in your own assumptions, you probably want to stick to these blue cells because the other cells have equations that are linked to these. So you could just change, for instance, monthly active user growth rates or average revenue per user and by segment, and then that would automatically change the earnings estimates in the income statement up above. So you can see down here is where we get into management's guidance. So we'll start there. Before we even go into the details of our assumptions for how revenue changed, let's just go through the few items that management did give us guidance on. So we'll just go back to last quarter's transcript. And you can see they don't actually give guidance for revenue, which is kind of a pain. But they do give guidance for expenses. So they say total full year 2016 GAAP expenses will grow by approximately 30 to 40%. And full year 2016 total non-GAAP expenses will grow by 45 to 55%. So before we get to the expense number, I just want to talk about the non-GAAP items. So they give that detail down here, and that's important because it's obviously making up this difference between the 30 to 40% and 45 to 55%. So you can see stock-based comp is expected to be between 3.1 and 3.3 billion. and amortization expense is expected to be 700 to 800 million. So now let's go to our model, and we're going to start there. So you can see we have a non-GAAP adjustment section at the bottom of our segment details. And the guidance for amortization is pretty straightforward. So they guided between 700 and 800 million. So we just broke that midpoint 750 up between each of the quarters. So 188 million of amortization of intangibles for each one of the quarters. And if you look at last year, that's actually in line with the average. So the average for the full year was 183. So now we're at 188. So that's reasonable. And if we look at stock-based comp, the guided range was 3.1 to 3.3 billion. So we hit the midpoint of that range at 3.2 billion. And then we just allocate to the cost of goods sold and the other OPEX items based on a similar percentage that we saw in the past. So you can see we're now at the midpoint of management's range for those two items. Now we can go back to the growth rate and expenses. So remember, on a GAAP basis, they said that they expected expenses to grow 30 to 40%. So this is the calculation. So it looks a little crazy because Facebook does it a little bit differently than some other companies. So they don't actually guide gross profit and operating profit. They're guiding total expenses, which includes cost of revenue and the OPEX items. So you can see here, cost of revenue, research and development, marketing and sales, and general and administrative. So they're guiding all of those expenses. So all this equation is doing is calculating the percentage growth for the full year 2016 versus 2015. So you can see, based on our estimates for gross margin, research and development, marketing and sales, and general and administrative, we were able to get back to 37% growth year over year. So that's a little bit higher than the midpoint of the range, but not by that much. So we're in that range. Then we already talked about our non-GAAP adjustments. So you can see, based on our GAAP items plus the adjustments, we get back to total non-GAAP expense growth rate of 52%, which is, again, just above the midpoint of 50% growth rate, but still within management's range. Okay, so other than the expenses, management doesn't give much other guidance except for CapEx. So they guided to be between 4 billion and 4.5 billion. So there's still a number of things that they're investing in. That shows up in the cash flow statement. So if you scroll down to our cash flow, you can see that we set it to the midpoint of that range at 4.25 billion for the full year 2016. So not too much guidance, but if you look at this, we were able to get back. I mean, obviously they didn't guide revenue, but we were able to get back to the EPS estimates that the street had based on that guidance. So that's basically saying that all in all, the street is in line with management's guidance heading into this release. So let's take a look at how we got back to those revenue estimates. So we scroll down to the segment details. And this is where we actually had a change in our model this quarter. So first, we kind of take a look at, let's ignore the details by geography, but let's look at the core Facebook business. So the way we model it is we take the monthly active users for each one of the regions. So you can see US and Canada, Europe, Asia Pacific, and rest of world. And, sorry, this is the monthly active users. And we apply a growth rate to the current user base to come up with our new monthly active users for the forecasted period. And then we apply an average revenue per user for each one of those regions. And that gets us back to our total revenue. So that was how we did the total earnings model for Facebook in the past. But now we have to introduce some new aspects to that model. So we didn't actually separate Instagram from the revenue per active user. So that's going to show up in this ARPU number here. But for the virtual reality business, we actually need to separate that because it's not earned on a per user basis. So you can see here we have input these new rows for virtual reality. And most of that is going to come from Oculus Rift. So for right now, we have a simplistic model. We just take the total number of units sold, multiply it by the average selling price per unit. That gets us to total revenue. And then we apply a gross margin to that revenue to come up with total gross profit. So you can see we are basically assuming that they didn't actually ship any units at the end of the first quarter. So this might be a small number here if they did manage to get some units out at the end of the quarter, but it's not going to be material to earnings overall. But we start to ramp after that, and you can see if you expand 2017, we basically get to a million units per year. That might be a little bit too low, but this is really just a starting point, so we can increase this based on comments that we received from management tonight. Then if you think about gross margins, so since they're not really shipping too many units and there's a lot of costs associated with just running a low volume business, for the time being, we just set the gross margin to 0. So we're saying that this will impact the revenue line, but all in all, it's not going to be profitable right off the bat. So that might not be the case. We might actually have a pretty significant gross margin. If that's the case, we'll change that if need be. But for the time being, that's how we're setting it up. This is basically just to be a placeholder at this point. And it's the same thing for the Samsung Gear VR wear. So we know that the Gear is shipping with the Oculus software, but we're not exactly sure what kind of revenue and gross margin contribution that'll have. So we would expect the gross profit to be very high because it's software, but we're not really sure what that number is. So we basically put $1 million of revenue here, which is, again, just a placeholder. This is not meaningful to our total earnings contribution. So once we get additional details, we'll put that in there as well. So for the time being, it's really the Facebook core business, which is making up most of earnings here. So these are the cells that you would want to stick to if you want to run some sensitivity analysis ahead of the release, just to see what the impact would be. And you can also kind of take a look at this relative to the historic growth rates or the historic average revenue per user, just to see if the estimates that we needed to use to get back to the consensus revenue makes sense. So if you look at US and Canada, we're expecting 1.5% growth rate for the first quarter, and then 1% after that. And if you look at what it's been over the last couple of quarters, it reached about 1.4 in the June quarter, and then it had a very strong growth rate in September, and that was followed by a weak showing in December. So we're saying off of that lower base in December, we should get a little bit of a recovery, and we'll see 1.5% growth in US and Canada, and then after that stabilize back down to the average over the last year of about 1%. And you can see we followed similar trends in the other regions. And then if you look at the average revenue per user, you'll see these very exact numbers in the US and Canada region. And that's because we set what we wanted our average revenue per user in each one of the other regions to be based on seasonality. And you can see that like in the December quarter, they tend to earn more than any other quarter. That's with the holiday advertising season. And then it sort of drops off in the March quarter, and then it kind of comes back in June and September, and then back again to a strong showing in December. So we set the other regions to what we wanted the ARPU to be based on historic seasonality. And then we backed into the US and Canada ARPU that got us to the total revenue per consensus estimates. So that's kind of the key, right? Like if you wanted to change these and say, well, I think the consensus is wrong. I think the average revenue per user is going to be much higher than $11.66 per quarter for the first quarter, based on, whatever factors you want to think about, like the monetization of Instagram or just in general, more ad loads or whatever it might be. So you could just change this number to be $12.50 or whatever you think it's going to be, and the revenue will change and everything else will change through the income statement, and the EPS will change. So you can see in this, just by changing that, the estimate for EPS goes to 65 cents from 63 cents. So you got 2 cents of additional EPS just by changing this one metric here. So that's kind of how you would run your sensitivity analysis ahead of the release. And you can change any of these blue cells too. So you can change all of these ratios or whatever you might want to do to take a look at what the impact is on overall earnings. Okay, for the valuation, this is a tier 1 model, which means we have 2 approaches to the valuation. So we have a multiple-based approach, which you see here at the bottom of the cash flow statement. And then we have a discounted cash flow valuation. So for the multiple evaluation, it's pretty simplistic. We take the next 12-month price earnings ratio over the last 3 months, and we take a look at the average, the high, and the low, and we've set it close to the average, which is on an X cash basis. So you can see we value cash separately, and that gets us to $108 valuation. So you can easily change this valuation if you think that this multiple is too low or too high. You know, that you can just change this to anything you want. So if you wanted to go to $30, just change that, and you see that the value moves right away. Now, the DCF-based approach is much more complex. There are many, many inputs in here, and we actually have a full demonstration of how our discounted cash flow valuation works posted on the education tab on our website. So if you go back here, you can click on this, and you can see this goes through our entire approach, introduction to financial modeling, and then here's the DCF, so how we calculate the inputs to the DCF and how we actually do the DCF valuation. So if you're interested in how our approach works, definitely check out those 2 videos. It'll go through the full calculation. But essentially what it's doing is it's calculating a weighted average cost of capital, which we use as the discount rate. We have a 2-stage discount model. So we basically predict out the cash flows for the next 5 years, and then we discount those back at the weighted average cost of capital. And then at that point, we assume the company reaches a constant growth stage, and we hold that growth in perpetuity and use the weighted average cost of capital to get the terminal value based on those growth rates. And we leave these inputs constant after the press release comes out, so we can see and isolate the impact of the valuation just on changes in earnings. So that's kind of like the key here. But similar to the multiple-based approach, you can change any of these values here. So if you wanted to see what the impact of higher volatility or higher interest rates would be, you can change this. If you think the Fed's going to raise rates by 100 basis points and you want to see what the impact would be, you could just change this to 3% and see what happens to the DCF-based valuation. So you can see it's pretty sensitive to changes in interest rates and changes in volatility. So that's another thing to look for. So definitely join us tonight at 4 p.m. Starting at 4 p.m., we'll start that live broadcast. So if you want to see what our updates to this earnings model look like, and be sure to check back after the release. We'll also post this model with the full details for March and the additional guidance that management gives for the full year 2016 to our website. And good luck with the release, and good luck with the rest of earnings season. Thanks for watching.